Van Der Linde, Head of Asian Equity with HSBC. He joins us now. Let's connect with him to understand his worldview, what is HSBC indicating their clients, and where does India fit in despite expensive valuations. Good morning. Great to have you back on ET Now.
Good morning. Thanks for having me on.
What is your view of the world? Are we heading into more volatility, lot of downside? Do you think, given the way how the global macro is moving, it's time now to be risk averse?
No, I think the world is, for the moment, still a reasonably good place. There's no immediate signs of any particular recessions. We have room to cut interest rates. That's all very good. Where the worry lies is that a lot of the positioning across the region is extremely concentrated. Everybody's overweight AI. That's adjusting at the moment. Everybody's, for example, also overweight India. Everybody's underweight on China. That's just in Asia, but we see this around the world as well. And the dynamics are changing. We now see, for example, that interest rates are being cut in the US. We've seen the yen strengthening, the dollar weakening a little bit. So these crowded positions need to unwind, and that will sometimes create simply volatility in markets. So that's how we see the world.
Right. So, Herald, are you saying, morning firstly, that this is just a little bit of a knee-jerk in an otherwise intact bull market globally?
Yeah, I think we still like risk assets, but a lot of the bull market stuff has rallied. So the US has performed very good. We're still overweight, but clearly there's risk to it after this particular rally. So I think within equities, I'm still positive, but you need to really look for the places where, the crowded trades, you want to avoid the crowded trades where you don't want to go where everybody's been hiding, because as that all changes, then you get a few people exiting the door, and you know what the proverb says, right? It gets really, that creates market volatility.
So where would that be then? Some of the sectors where everyone is hiding that one should perhaps be avoiding, and where is it that there is opportunity within the India market?
Yeah. So let's take Asia first, and then because that will reflect very easily in India. AI exporters do not look necessarily good because of the yen, the dollar, the strength in the weakness in the dollar, the strength in some of these currencies. So you want to avoid that. Taiwan, for example, is a really crowded space. We're on the way to that particular market. You want to go for the markets where there is strong domestic demand and that can benefit from lower interest rates coming through. In a lot of markets, Indonesia is a very nice example. The Philippines, interest rates have been actually too high of what the policymakers really want them to be. They're waiting for the Fed to cut. In India, the story is to a large extent the same. Where can they cut maybe interest rates? Which sectors would benefit from that? And you want to probably be a little bit careful with the globally exposed sectors. In particular, any stock or sector that also has that exposure to, for example, AI.
You've used the word AI in India perhaps 6 or 7 times in a 3-minute interview. Why is that?
Because what we see around the world is, I think, that a lot of that money has gone into AI trades, and that is unwinding, and that is impacting all the markets. Look at, for example, today we've had some of the key US stocks coming down overnight, and we see a reallocation of capital within the region. Taiwan is weak, is under pressure, and that money needs to go somewhere else. Japan is not an alternative. So then you end up really, ASEAN is rather small. So then you end up with China, which is a China story, and then you end up with India. So India, in that sense, will be impacted by these global readjustments that we see, in particular in the AI, global AI sector.
Okay, so let's talk about India, and really let's understand the foreign view. Now, India is perhaps both on a relative basis and absolute basis in a good spot. But despite that, the FI investments into India has been a bit patchy. So can I say that this is the mystery, that this is the most preferred market in the world, and what is driving this market higher is not global liquidity, it is domestic liquidity, and global investors are still underweight India?
Yeah, I mean, this is the answer to it. There's two things going on for here. First of all, you are right. Domestics are buying, and therefore, by definition, foreigners need to sell. Otherwise, domestics can't buy. So the domestic investors are crowding out the foreign investors. So that is one particular issue. The second issue is that the foreign investors are getting a little bit more nervous on the valuations. It's still a sort of blue sky sort of story in India. Growth is good. There's multiple growth drivers. Formalization of retail is taking over, and all these sort of things. You guys have spoken about this quite a lot already. But you also see the first cracks starting to appear, right? Deposit rates, margins, second quarter profits were not so very strong. So you see that in the banking system, a little bit of stress starts to emerge. So people say, well, the combination of very high valuations, and we see a couple of stress points in India as well. Maybe we need to be a little bit careful. So I think it's that particular combination with domestic buying and the foreigners saying, hey, I don't want to really buy them out, these local investors, that is causing them therefore to be underweight on India. They're small underweight. They like the story, it's just that they want to take additional positions.
When you say Indian markets are expensive, what is the context here? Are you looking at historical benchmark, and is historical benchmark the right way to look at India?
Actually, for a lot of markets, I would say, no, history is not good. I think for India, maybe it is actually. India is expensive. So if you look at any particular multiples, PE, price to book, it is high, simple. But there's a good reason for it. India is the most profitable market in the region. Indian companies belong to some of the most profitable companies on the planet, actually. So that is right. I actually think that part of that sort of secret that India has is twofold. It is distribution. And the companies that can distribute simple sort of products in India are very, very profitable. You think about some of these companies that sell milk, toothpaste, food, cigarettes, and these sort of things. But as India is going to put more infrastructure in place over the next couple of years, I think competition is going to rise and profitability might come down. So the past was probably really good for India. The future profitability might come down, valuations as well. So making some historical sort of comparisons, I think, is still valid in India. That's much less so the case in other markets.
Given that interest rates are headed lower, now whether it's 25 bips or 50 bips, we don't know, but we know for sure that interest rates are headed lower. Historically, when Fed has cut rates, money has moved back to emerging markets, money has moved back to commodities. Do you think the same playbook could be at play?
Yeah, I do think so. Which is why in the beginning I said we like risk assets and we like equities in that sense. So that is this is the advantage that we have at the moment. Yes, growth is slowing around the world, but we have this cushion, we have these tools available, lower interest rates that can help us out for the moment. So that is good. That is good for emerging markets. And the question then in emerging markets is where they go, right? And if you think about Asia, well, they can't really go to, for example, Taiwan because they're already there. Korea is also AI exposed. China has got a different sort of story. So then you got this, and that's where India then ends up. If things start to improve a bit in China, I could see that absorbs quite a lot of capital. But at the moment, there's still a bit of a question mark out there. And that's why I stressed that AI sort of rally in the beginning, because the foreign flows into India are an outcome of those flows into EM, but also outflows from the AI trade that we see globally unfolding.
In the light of the next big thing, what could be that next big thing? For example, in 2021, the next big thing was India. In 2018, the next big thing was Bitcoin. Before that, it was US tech. Before that, it was China. What could be the next big thing according to HSBC?
There's a couple of things that we look at. We look at a couple of themes, for example, so future transport, future cities, smart cities, and these sort of things. A lot of is already said on that. That is quite important. I think actually when it comes to market performance, the next big thing in Asia could simply be the state of China. China has got a lot of things going against it. Sentiment is really poor, but there are incrementally positive things starting to unfold in China. So the next big thing could well be that money actually starts to flow back to China. I got the impression that...
If I may just come back with a follow-up question on the transport part which you just mentioned. Can you elaborate on that? Because that's something which we are really intrigued about knowing more about.
We're not getting his audio actually. It got snapped even in the previous answer.
We can see you, but we cannot hear you. So we'll fix it.
We're just going to try and patch that back. Let's just, take stock of what the market is settling in at, because the weakness is not getting bought into. 165 points lower still for the Nifty futures. It's only the crude sensitives which are actually supportive today. So Asian Paints, Pidilite, Berger Paints, they are the ones which are holding out. Of course, there are others also, BPCL for instance, that is holding out in trade. Hero MotoCorp for a third consecutive session this week. It's been actually holding out. News reports indicating that they're looking at launching an EV three-wheeler, and that's what's keeping the stock excited. There's, of course, Bajaj Finserv as well. A big day on Monday, upwards. Yesterday, down day. And today it's just about mildly flattish. But I think Herald is back with us and he can hear us, and hopefully we can also hear him. Yeah, go ahead, Herald.
I can hear you and I can see you. So I hope the connection is re-established. The question was on future transport. What is the big thing there? What we see is that China is really starting to export a lot of cheaper electric vehicles around the world. So we're seeing a push of a lot of Chinese products, oversupply in China effectively being exported into many other countries. And that can be good sometimes for consumers who have more choice at lower prices, but it also means that the competition in some of these markets can pick up. India, in a sense, would play a role in that as well, insofar Chinese companies are able to access that particular market.
Okay. In the other theme, which perhaps could be a relevant one, is that what could be the implications of which way right now the commodity prices are moving, which is that there is this whole obsession with China that is getting over, and that in a sense will have a huge impact on the way how commodity trends would emerge. India on one side has started consuming more commodity, but nowhere close to what Chinese have consumed at their peak. How do you see the commodity demand moving in the light of what is happening in the world?
I think, first of all, what you see in China is a shift in the nature of demand, because they don't want to invest in property, they don't want to invest in hard infrastructure anymore, but high-end tech. You see a shift in demand, and that means for a lot of the traditional commodities, think about steel, aluminum, and these sort of things, that demand will slow. Now, India is building out its infrastructure, but probably can't initially offset that, only maybe later on. So there, you're going to be a little bit careful. The thing that China does do, of course, it's building out all sorts of new sort of capacity. Think about chip centers, once high-end chips, renewables, and these sort of things. And particular metals will be required for that. Now, some of them are very specific, rare earth, but other ones are, for example, copper and these sort of things. As copper intensity in solar panels is about 4 times as much as in many other products. So you see that demand for copper probably will remain okay, but for a lot of other products, it's probably going to slow from here on.
Let me divide my question or next question more in terms of time horizon. And immediately after this call, you get a call which is that, Herald, we watched you on ET Now and we would like to just endorse your thoughts here. But if a client has a query which is on the following lines, which is that in the short term, which is 6 to 1 year, which could be a preferred asset class, in the medium term, which is 1 to 3 years, what is the best trade or investment, and in the long term, which is 5 year plus, what is the best investment idea? How would you advise that client? 1 year, okay. Short term, medium term, 1 to 3, long term, 5 year plus.
Okay. I think for the short term and the long term, I think you want to continue to be overweight on the equity side. The short term, really, because we have this lower interest rate story coming through, that will help out. And in the longer run, I just believe in the sort of innovation that companies can generate globally that allows these markets to perform over the longer run. In the medium term, that would be a little bit different, because interest rates are moving lower. That's good for equities in the near term, but there will be worries about growth coming through in the medium term. So in the medium term, I would probably say maybe go for something that is more income-centric, bonds or something like that, that might provide you some support in case we see that growth worries are going to dampen the outlook for equities. But short term and longer term, I think equities look good.
Right, Herald, so good having you on the show. Thank you so much for taking the time out and speaking with us today.
Thank you very much for having me.